Welcome and thank you for joining me for LPL Research Presents Outlook 2024, A Turning Point. This session is being recorded and you'll receive a link to the recording from the session in a follow-up email. LPL Research believes the recession is likely to emerge in 2024 as consumers, under increasing debt burdens, deplete their excess savings and are no longer able to keep up with debt payments. Leading indicators that we've been watching include an increase in serious delinquencies in credit cards and auto loans. We expect spending to splurge to end, with consumers reverting to trend. In 2024, the consumer will no longer be willing to spend as they did in 2023. We expect to see a Federal Reserve focused less on inflation and more on the other part of their dual mandate, stable growth. As already highlighted, inflation will still hover above the 2% long-term run target and remain a concern, but the Fed will likely be less laser-focused given the trajectory is going in the right direction. When it comes to the job market, some call the recent shift in favor of the average worker the democratization of the workforce, considering that workers have rarely had this much bargaining power. As the American worker has had a few years to adjust to the hybrid work model, we should continue to see a fair amount of turnover. Some have seen the fastest way to higher pay is moving to a new job. Of course, the hybrid model can only operate in some sectors, so its impact varies depending on the industry. LPL Research forecasts for economic growth and consumer inflation across regions in 2024. We can see the GDP growth for the U.S. set at 1%, while the highest in this chart is the emerging markets at 3.9. We can also see in the right column the consumer price index forecast year over year for the U.S. is 2.8%, which is at the lower area of the range for the different countries that are cited here. As the next 12 months of the bull gets underway, market history tells us solid gains may lie ahead. Of the 12 such periods since 1950, the S&P 500 has gained an average of 12.6% and was positive every time. A gain of this magnitude seems reasonable given the potential for support from the Fed as inflation falls. With inflation still elevated, high rates remain a threat to the economy and the stock market. Stocks and bond yields became increasingly negatively correlated, moving in opposite directions in 2023. While that wasn't great news for the stock market, it does mean interest rates could present an opportunity, as LPL Research believes the 10-year Treasury yield could be less volatile in 2024. Our 2024 S&P 500 earnings per share, or EPS forecast, is $235 per share, up from the prior estimate of $230. The new estimate represents only about a 7% earnings growth from the current 2023 consensus S&P 500 EPS estimate of $219. Beyond economic growth, how companies manage waning pricing power as inflation falls is key to the earnings outlook. Reversals of 2023 earnings declines by the healthcare and the natural resource sectors, along with increased earnings growth in the technology sector, will help drive a turnaround in overall earnings. Stock valuations are high by most measures. The price to earnings ratio, or PE, based on the consensus S&P 500 earnings per share estimate for the next 12 months is 18.8, above long-term averages in the 15 to 16 range. Factoring in interest rates allows for a more complete valuation assessment, as a stock's fundamental value is derived from the present value of future earnings. Plus, yields from bonds provide competition for stocks. Comparing the earnings yield for equities, earnings divided by price, to the yield on bonds using the 10-year Treasury, we arrive at an equity risk premium for the S&P 500 near zero, suggesting equities are fully valued. While earnings growth will likely help push stocks higher in 2024, the contribution from valuations may be more limited. Stocks appreciate in value primarily two ways. Either earnings grow or valuations become richer. The good news is that stocks can move higher in the coming year without much help from the valuations, a different story from the past 2 years. A price to earnings ratio of 19.5, in line with the 5-year average, represents only a slight improvement in valuations from the 18.8 level of mid-November. Based on a PE ratio of 19.5 times our projected 2025 S&P 500 earnings per share of 250, we estimate the fair value range for the S&P 500 at the end of 2024 to be between 48.50 and 49.50. This suggests some potential high single-digit gains at the midpoint. With the economic data so far continuing to reflect a more resilient economy than originally expected, we think Treasury yields are likely going to stay higher for longer as well. As such, we think the 10-year Treasury yield could stay in the 3.75 and 4.25 range, with risks roughly balanced. However, while we think the economic data softens in 2024, which should allow the Fed to gradually adjust monetary policy lower, we can't entirely rule out 2 other scenarios either: traditional recession or a re-accelerating economic environment. How much higher could rates go? Looking at interest rates over a longer time horizon provides perhaps a bit more clarity on what could be considered normal for interest rates. Data since 1880 shows that interest rates were in a fairly tight range before the spike in interest rates that took the 10-year Treasury yield to those very lofty levels in the 1980s. In fact, long-term rates mostly traded within a 3 to 5% range for nearly a century before moving aggressively higher as the Fed fought those generationally high inflationary pressures. Periods outside of that 3 to 5% range have resulted from the economy's growth and inflation dynamics, which ultimately shapes the Fed's interest rate policy. So, the sharp increase in the 10-year yield over the past few years puts the yield firmly back into the normal historical range. The corporate credit markets have been resilient so far in this cycle, with credit spreads, or the additional compensation for owning risky debt, remaining below historical averages. However, with the Treasury increased yields over the past few years, corporate interest payments are set to increase as well. And while the health of the corporate landscape is generally positive, rating agencies are starting to adjust their outlooks based upon, among other things, the expected increase in debt payments. The ratings environment remains relatively calm for companies across investment grade. However, lower-rated companies have taken the brunt of the downgrades and will likely to continue in the coming quarters. Year to date, S&P has downgraded its outlook and the outright rating of 814 companies, both investment grade and high yield, versus only 512 upgrades, which makes 2023 already the worst year for downgrades since 2020. Commodity prices have been easing lower as the global economic landscape, particularly as China's slowing economic recovery, continues to soften. The dollar is stronger compared to foreign currencies because of favorable interest rates, but is overvalued compared to the yen, euro, and British pound. Capital flowing back to the US accordingly. The yen is the weakest because the Bank of Japan hasn't acted. The US dollar is clearly very expensive on a historical and relative basis, and there's going to be value in holding foreign denominated assets in the longer term. It will make sense soon to own foreign assets on an unhedged basis. Until we see a pessimistic shift towards synchronized global growth and central bank tightening, for example, not US-led, foreign currencies as a whole will likely struggle to meaningfully outpace the dollar. In summary, for the outlook for 2024, the economy is expected to slow down. Stocks follow the cycles. Expect earnings growth to accelerate and support stock prices. And with bonds, it's back to normal. While LPL research does not try to predict the future, this information is provided as a broad guideline as to what one might expect in the coming year. The best way to deal with an unpredictable nature of the markets is to have a financial plan for your goals and follow that along with your investment objectives. You'll receive a link to our resources page where you can access and download the investor recap or the full report to read at your leisure. There will also be a link to schedule up a follow-up meeting to ask any further questions about today's presentation. Thank you for attending. Our next event will be February 28th at noon Central or 1 Eastern. And our topic will be 6 steps to legacy planning for the generations. Learn to craft your legacy and leave your mark for the next generation. That's a class that's going to be about estate planning for your family. Hope you can join us for that. Thank you again for attending. I hope you found this information insightful. Have a great rest of the day.